Hi, I'm TJ Kistner, Chief Investment Officer at Retirement Plan Advisors. Today, I'll walk through market performance for the fourth quarter of 2025 and share our forward-looking views as we head into the new year. We hope you find the discussion helpful and informative. We closed out 2025 with markets continuing the remarkable momentum that defined much of the year. The macro backdrop remained supportive. GDP growth stayed resilient, inflation continued to trend lower, and the Federal Reserve delivered its third rate cut of the year in December, bringing its policy rate to 3.75%. Corporate earnings were strong across most sectors, and profit margins held near record levels despite ongoing global trade frictions. And equity markets responded accordingly, as virtually every major market finished with double-digit gains. Most notable was the strength outside the US, as developed and emerging markets delivered 30+% gains during the year. In the US, the S&P 500 experienced an historic rally, finishing the year up more than 40% from the April lows and posting over 30 record closes in 2025. In fact, there have only been 3 V-shaped market recoveries stronger than the one in 2025. One in 1982, in 2009 post the global financial crisis, and in 2020 post-COVID. The Magnificent Seven stocks had another great year, and the weight of these stocks in the S&P 500 reached an all-time high of 36% in November. But the strength was really only driven by 2 stocks, Google and Nvidia, and the other 5 stocks underperformed the broader S&P 500 for the year. In aggregate, these companies continue to generate significant earnings growth, accounting for around 30% of the index's earnings during the year. In fixed income, falling interest rates boosted bond prices, and both core and high-yield bonds delivered solid results in the fourth quarter. For the full year, core bonds returned over 7%, while high yield finished closer to 9%. Longer-term yields remain more stubborn, barely moving from the beginning of the year, reflecting some lingering concerns that easier monetary policy could reignite inflation, and that remains something that we are watching very closely. Beginning in late March, we maintained an overweight to equities throughout most of the year, which was a meaningful contributor to our clients' performance. As we look into 2026, we continue to see reasons for optimism. Economic growth remains steady, corporate balance sheets are healthy, and the Fed appears committed to a gradual path of easing. And we're finally also seeing expectations for synchronized earnings growth, even in areas such as mid-cap and small-cap that have significantly lagged over the last 2 to 3 years, which could present tremendous opportunities. That said, we're mindful of areas where expectations have become elevated. I mentioned the outsized impact that the Magnificent Seven have had on the S&P 500, and the technology sector's weight is now well above levels seen at the peak of the dot-com era. While the fundamentals behind these companies remain strong, concentration risk is real, and we believe investors may benefit from broadening out their exposure. If 2025 taught us anything, it's that diversification can prove valuable in portfolios. Thank you for listening. We hope you found this update helpful, and from all of us at RPA, we wish you and your loved ones a very happy, healthy, and prosperous new year. And remember, the future is better than you think.